Well, here we are. Earlier this year, all the experts were telling us by the end of 2023, we're going to have 5%, 5.5% mortgage rates once again. Well, what has happened? Where are those 5% mortgage rates, guys? Oh wait, they're not here. In fact, now we're up to 8% mortgage rates, maybe even higher for a lot of people. And I kind of like rubbing this in because these guys were so wrong on such an epic level. It's just unbelievable how wrong those mortgage rate predictions actually were. My prediction earlier this year was that we were going to end this year probably somewhere around the 7s for mortgage rates, and we're in the 7s right now, but we were actually a lot higher than that depending on what type of borrower you are. Let's take a look at something here. When you look at Mortgage News Daily, the 30-year fixed rate is at 7.69% today. But that's not based on your credit score or your home price, your loan amount, anything that you're trying to get. That's just where the 30-year rates are pegged at right now. But when you look at Google's version of this, and it says, hey, if you want a 30-year fixed mortgage, you have a $300K loan in California, and you have a 700 credit score right now, you're looking at an 8.5% rate, guys. 8.5%. So by the end of this year, we could be close to double-digit mortgage rates if things keep going like this. And some people might say like, whoa, how is that possible, Michael? Because even if the Fed raises rates, it's only going to be by another 25 basis points by the end of this month or in November, whatever it is. How is it going to go up to 10% mortgage rates? Well, it's because the Treasury, the 10-year Treasury is still climbing, guys. The Treasury continues to climb because investors are scared right now. People who are investing into long-term treasuries like 10 years, they want a higher yield right now because of how shaky ground everything is on at the moment. And since 10-year treasuries are basically pegged to 30-year mortgages, the higher that treasury rate goes, the higher you're going to see mortgages go as well. And that's where we're headed, guys. That's why you're seeing people have to pay 8.5% rates right now for an average 700 credit score. And that's just for getting a $300,000 loan amount. And by the way, I'm walking over here in this place called San Pedro Estates, and there's like a little park next door. It's not far from the marina that I did the video with Adam from Wealthion, so it's a pretty cool little spot over here. Somebody who watches my channel, who's a mortgage broker, told me that a lot of the buyers that he's seeing are having to buy down their rate into the 7s right now. They're doing that by paying a point up front or a 1.5, whatever it is. If you're getting quoted at 8.5% and you want a 7.5% rate, you got to pay mortgage points up front. And that's great and all, but to me, it's kind of pointless because once you get past the 7% interest rates like we're at right now, it's almost like it doesn't even matter anymore, guys. Like, it's already so expensive. It's already so far beyond people's budget. And I wouldn't exactly be proud to be paying points to lock in a 7 or 7.5% interest rate right now, because if you put a high enough down payment, then what's going to happen is actually going to lower your payment by more than paying down the points. And I'll show you guys what I mean here in just a minute. And this is also why home prices are more important than interest rates. And I have a very good example here to show you exactly what I mean. So say you're buying a $525,000 house at 20% down and an 8.5% interest rate. That'll give you a $3,900 a month mortgage payment. But then if you were to buy down your interest rate to 7.5%, that would lower your monthly house payment by about $300 a month to $3,620 per month. However, if you were able to just keep that 8.5% interest rate and put a higher down payment, say 40% down, now you lowered your monthly payment from $3,900 a month to $3,100 per month. So now you just saved $800 per month instead of $300 per month by doubling your down payment. And obviously the biggest obstacle for most folks doing this is the fact that they probably don't have an extra $210,000 laying around to make a bigger down payment. And that's the biggest issue. This experiment or exercise essentially shows to you and proves to you putting down more money on a house or getting a cheaper house versus getting a more expensive house at these interest rates is actually the better bet for you in the long run, because not only will it lower your monthly payment by more, but also it will give you more equity. So that way, when it comes time to actually refinance the house, which will come at some point in the future, who cares? Why would you pay to lower your interest rate if, say, in 5 years from now you could refinance, okay? doesn't really make a lot of sense most of the time. So you're better off putting the extra money into it now. Home prices go down and you'll still have the equity to be able to refinance when the time actually comes. That would be the smart move right now if it were me, if you have the cash. But that's the only way this works. You got to have a lot of money to put down up front on the property, which unfortunately most folks don't have. But I think this is the better deal in the long run, especially if you're planning on keeping the house for a long time, because it gives you immediate equity up front. It gives you the ability to refinance when rates do come down, because chances are your house won't fall by 40%. It could. I'm not saying it. That's not possible, guys, and you know me. I will definitely tell you if things are possible, and it is possible for that to happen. So I wouldn't be counting on the fact that you'll be able to refinance, but it gives you a much bigger shot at being able to. But it looks like these 8% mortgages are going to be here to stay for quite some time, if not even continue to go even higher. And this looks like this finally getting to the point where it's enough to start really making a dent in this housing market in terms of slowing down transactions, guys, because I showed you guys a few days ago in a video that when you look at the inventory numbers on Redfin's website, it shows that the inventory is continuing to build little by little right now, month by month, at a time of year when seasonally, traditionally speaking, the inventory will usually go down. Because as we enter the fall and winter months, people stop listing their homes for sale. And even though there might not be more people listing their homes for sale right now, there's so few buyers out there to absorb the houses that are for sale that they're not being sold. And you're seeing a lot of houses come back on the market because they're not passing inspection, or people can't make a deal, or they thought they were going to be able to get a 7% interest rate and now it's 8.5%. So all these different problems that you run into when purchasing a home at the moment. And it looks like it's starting to work, these interest rate hikes, in terms of slowing down the purchases. But we still haven't seen major drops in price yet, at least not when it comes to existing home sales. We've only seen those big effects on new construction so far. Now obviously, even though these mortgage rates are not helping more people list their homes for sale, that's definitely a big deterrent for people to do that. What it is doing is it's making buyers pause and hesitate and finally start to look at this and say, well, maybe we should wait, because it wasn't that long ago. People still probably have fresh in their minds of when mortgage interest rates were still in the 3% range just 2 years ago, guys. That doesn't seem like that long ago, because it wasn't. And now fast forward to today, you're looking at 8% unless you want to buy points. And so I think a lot of people are looking at that and saying, you know what, maybe it's best we wait this thing out. And I think that's kind of the psychological trick that's finally going to get people to wait. Nobody wants to have an 8 or 8.5% mortgage rate when home prices are over $400,000. Nobody wants that. People are finally starting to wake up, because you're starting to see the amount of transactions fall off of a cliff and the amount of inventory is going up. Like literally just in 1 week, we had inventory go up by 1.3%. That's pretty significant for just 1 week. Basically, my prediction from this, if things keep moving in this direction, is you're just going to see more and more people sit on the sidelines out of unaffordability, or out of now realizing that, hey, these rates are way too high, especially at these prices. But the problem is inventory will continue to build, and that's where you're slowly going to start seeing inventory hit the market and more options become available. And this might not be an actual housing crash, so to speak, like we saw back in 2008, where millions of listings were hitting the market within just a few short years because of distress. Maybe it's just because things are so unaffordable that the listings will continue to pile up as interest rates remain higher for longer and no one buys these listings. Okay, that's where I think things are headed, at least right now, based on this current trajectory. So we're definitely living in interesting times when it comes to this housing market. We're at the point now where the only people who are going to be buying or selling a home are people that absolutely have to, if they are in distress, if they have a job loss, if they need to move for a job or a family circumstance, something like that. People that just need to sell or buy something are going to be pretty much the only people left right now in this market. Investors, what are you going to invest in? You can't cash flow anything. Regular home buyers can't afford it. Now, another sign of distress for the economy in general right now is commercial real estate. And we're literally seeing every single thing go wrong with commercial real estate that can possibly go wrong right now, here's the latest nail in the coffin for commercial real estate. We already know that a lot of these property values have plummeted by 50% or so. They have all this commercial debt that they're not able to refinance at an affordable rate, which is absolutely crushing all of these commercial buildings. But to top it all off, guys, insurance, okay? Insurance is a big problem now for these guys as well, just like it is for us regular homeowners. And in fact, insurance costs have been rising on average about 7.6% annually since 2017 for commercial buildings. On top of that, they're having to deal with higher vacancy rates, they're having to deal with higher interest rates, they're having to deal with lower rental income because people don't want to be in the office anymore. I mean, every single thing you can throw at the commercial real estate market is hitting it right now. And I think it's just going to be a matter of time before these problems bleed into the residential sector, simply because the economy is like one big machine, guys, and this is part of the machine. And when a part of the machine breaks, just like the interest rate hikes that we're seeing now, that's when you're going to see the most problems. So these increases in insurance rates can offset years of potential profit for these big buildings. And for example, in rental apartment buildings, you have insurance costs up 14.4% in Dallas. In Los Angeles, it's up 13%. And in Houston, Texas, it's up 12.6%. And that's for multifamily real estate, guys. That's not for a big office tower or a warehouse or anything like that. You're talking about places that people live in, where you have landlords that own these buildings to make a profit. And when you see just one expense go up by 14% in just 1 year, how is that sustainable? How do you keep the lights on like that? And that's just one expense. You also have property taxes. You also have other overhead. And so now that these commercial properties are in the same boat as residential real estate with insurance rate hikes, they're also doing the same things, guys. They are being forced to take on these more expensive policies and lose money, or just ditch insurance altogether and not have it. And that's only going to work, once again, for paid off properties. People that have a paid off multifamily, somebody that has a paid off office building, whatever, is able to do that, just like a homeowner that doesn't have a mortgage. But for the vast majority, they can't do it, and they have to just pay the extra. And this is really bad, guys, because these insurance hikes, the vacancy rate problems, the drop in the value of all these buildings is leading to the amount of commercial properties being sold dropping by 79% since 2021. That's how much people are not buying and selling these buildings right now, because nobody wants to touch them. And who could blame them? You know, you're basically getting a ticket to the Titanic with this. And the problem is, when you're running a business like this, especially a rental business where you're trying to make a profit by renting out any sort of property, whether it's commercial or residential, you need to be able to pull in more money each month than your expenses cost. But that's becoming a thing of the past with these high interest rates and higher insurance rates. And to me, it's only going to be a matter of time before you see more and more defaults on properties like this, guys. And if you don't think that's going to bleed into the rest of the economy, then you're not really paying attention, because all of this is connected. And even the economy right now has so many different headwinds. You know, the student loan debt completely resumed payments earlier this month, just a few days ago. The problem is, people that are already strapped for money are going to have a hard time making these payments, are not going to be spending the money in other places. So say you have $300 a month you have to start paying now towards the student loan debt. That's $300 a month you're not going to be spending at bars, restaurants, Airbnb, vacations, any other type of discretionary spending. All your money is going to be going towards necessities: food, gas, insurance, student loans, rent. And this is why this is going to be a problem no matter what. Because for people that have student loan debt, either they pull back on spending, which is going to slow down GDP, which is not good in terms of recessionary terms here in the United States, or they're going to have to keep on spending, either save less of their monthly income, or they take on more credit and more debt to keep up with their lifestyle. Neither one of those scenarios is actually good for the consumer that has student loan debt, guys. Either way, you're stretching yourself thin and putting an extra stressor on yourself and making it harder to just survive. It's still being debated whether or not this resumption of the student loan payments is going to have any significant impact on the economy. But I think with all these things converging right now, the problems with commercial real estate, the amount of buyers that aren't buying homes, which also means, real estate agents that aren't earning commissions and mortgage brokers that aren't earning commissions, and throw in the resumption of the student loan payments, and all of this combined kind of like converging right now at the end of the year. I think this is just setting us up for a home run recession any day now, guys, going into next year. I already am of the opinion, which most of you know, that we've been in a recession since last year, but I think it's going to become far more noticeable for many folks going into next year. That's what I'm thinking with all this going on. And unfortunately, Florida is starting to follow suit with some of these other states that have thought it would be a good idea to just give people free money. That's going to be the best way to combat the cost of living with everything. And Florida has introduced a new bill. Okay, it hasn't become law yet, but basically what it is to be able to help people pay for their mortgages, their insurance, and their rent payments because people are broke, essentially. And the representative that introduced this bill is saying that, Floridians who are struggling are going to get help paying these expenses, and too many people in the state are facing financial hardship, and this bill would provide them with the much needed relief. And basically it would provide people a grant up to $2,500 per household to help you with your mortgage payment, your homeowner's insurance, or your motor vehicle insurance. And this is going to be available to people who have household incomes from low to upper middle class. It doesn't actually say a dollar amount here. What they're saying this is going to do is going to help people stay in their homes and stay on the road, meaning they're not going to become homeless, they're not going to lose their car. And it also says that it's going to provide financial relief to people who are struggling to make mortgage and insurance payments. And the grants would help stimulate the economy by putting money back into the pockets of Floridians. And it would also help insurance companies receive the payments they need and stop them from becoming insolvent. So once again, you have government intervention trying to game the system, guys. And that's why I'm against this. I'm not against people getting help, but I'm against it because they already tried this during COVID on a national scale, and look at the disaster it got us in right now. And now we have people in Florida trying to turn us into California. We already saw that during the pandemic, giving away free money didn't work. All they did was create more inflation and make everything far more expensive. Look at what things cost today. Everything you can think of is more expensive than it was back in 2020 before everything went bizarre. Now, for example, if they would say, okay, well, you're behind on your mortgage or you're behind on your rent, and we're going to pay that money directly to your mortgage servicer or straight to your landlord if you can prove that you actually can't pay, then maybe this could help the right amount of people, just like I was talking about. Like in Colorado, they're giving homeless people money to try to get off the streets, and it worked for some of them, but probably not for the vast majority of them. But one thing that's been proven for sure is when the government just throws money at a problem, it tends to just get worse. When you look at California here, that's what they do with drugs and homelessness and crime. And now all that stuff is through the roof here because they're not actually addressing the root problem. They're just throwing money at it. And I am afraid that if they pass something like this in Florida, we're just going to be headed down the same path. And it's just going to make housing more expensive. It's going to make insurance more expensive, because once the government starts subsidizing anything, these companies know they can get away with it. They can get away with charging more for insurance because of this. If you think house is already too expensive now or rent is too expensive now, once you start helping more and more people pay, it makes the marketplace more competitive, and people are willing to pay more in rent and able to pay more for a house for sale, and so on and so forth. So all it does is amplify the problem in the end rather than make it better. And that's not my opinion. That's just going by past examples of what we've seen them do in places like this here in California and other places around the country where none of that stuff has actually worked. So I'll keep you posted. And in the meantime, if you enjoyed this video, make sure you subscribe to the channel. And if you don't want to wait for my next video to come out, check out this one on the screen right over here, and I'll see you in the next one.